What causes an economic depression? A depression is caused by an unexpected rapid rise in the value of the unit of account, combined with sticky wages, workers' resistance to nominal wage cuts, and sticky debt, long-term credit contracts like mortgages. The value of money is essentially a market, just like a market for apples or oil or cars. In normal, liquid markets, the price is set by the interaction of supply and demand. When prices are allowed to float, they settle on a value that allows the market to clear, and no suppliers want to make any more at that price, and no purchasers want to buy any more at that price. If the price mechanism is tampered with, then the market may not clear. For example, if the law requires a minimum price of sugar, and if that happens to be above the market clearing price of a free market, then what you'll find is that too many suppliers produce too much sugar, but there isn't enough demand at that price to purchase all of it. So you wind up with excess inventory. If, instead, the law requires below market prices, e.g., rent control for apartments or price caps on emergency supplies during natural disasters, then you'll find that there is tremendous pent-up demand, but not enough supply. That problem gets solved with off-market allocation, e.g., long lines for concert tickets, or restaurant tables under the table kickbacks, political favors, or perhaps first-come first-served, where the lucky ones at the front of the line get cheap products, but the latecomers find that they are unable to locate any supplies, at any price. They simply must do without. That's a regular market. Money value is also a market, and also has a supply of money, typically provided by a central bank of a modern fiat currency, and a demand for money related to money velocity, how big of balances people wish to keep in their wallets and checking accounts. Supply and demand for money can also vary, just like in any other market. The two big differences are, 1. With fiat currency, the supply of money is a simple choice on the part of the central bank, which can produce it for essentially zero cost, and 2. Money doesn't trade in any specific market, like apples at the grocery store, but instead the price of money is reflected in the general price level throughout the entire economy, for all other goods. Essentially, every other market in the economy is really a trade between that particular good and money. So if the central bank mismanages the supply of money, then the value of money will change quickly. Sometimes you get hyperinflation, e.g., Germany in the 1930s, or Zimbabwe today. That's when the supply of money is overproduced, and thus the value of money falls rapidly. The economic recession of the last few years is due to the opposite. Money demand rose suddenly, but the central banks especially, US Fed and European ECB, didn't expand the money supply sufficiently to accommodate the increased demand. This led to a rapidly rising value for money, the unit of account in numerous contracts. For highly liquid markets, like stocks or commodities like oil and sugar, changes in the value of money aren't especially significant. Those markets quickly reprice, and the markets clear again at the new prices. But some markets, especially wages and debts, have huge inertia in their pricing changes. Long-term labor contracts, and long-term debts like mortgages, which are contracted in strict nominal terms, generally without indexing for inflation, can take a long time to reprice to the new value of money. While they are stuck at mispriced levels, all such markets economy-wide suffer in the usual way, when prices are stuck away from their market clearing values. First, we need to clarify what constitutes a depression. Before the Great Depression, every economic downturn was called a depression. The term, recession, was coined to clarify the difference between the new phenomenon, the prolonged slump of the 1930s, and the brief recessions that had occurred prior. So a depression is a big recession that lasts a long time. One additional thing that needs to be clarified is that both recessions and depressions are cyclical phenomena, and are distinct from secular stagnation or decline. Recessions and depressions are temporary phenomena, so we wouldn't call the decline of the Roman Empire in the 3rd century, nor the economic decline of 14th century Europe, depressions. We would call them secular, or long-term, declines. A depression is a particularly long recession, so we have to answer two questions. 1. What causes recessions? And 2. What prolongs them into depressions? 1. Recessions can be caused by real factors such as wars or plagues. In the aftermath of a destructive event, it can take time for people to reorganize and reallocate factors of production to account for the new, post-disaster reality. Recessions can also be caused by wide-scale capital misallocation. This happens when banks expand the supply of credit without a corresponding increase in savings. This depresses the interest rate and misleads entrepreneurs into taking on long-term projects that are inconsistent with consumer preferences. This intertemporal discoordination creates an unsustainable boom as entrepreneurs bid up factor prices and wages. When the rate of credit expansion slows, interest rates rise and investments made during the boom are revealed to be malinvestments. A recession occurs as the now recognized malinvestments are rapidly liquidated. 2. Economies can recover from recessions if allowed to do so. The war, plague, or unsustainable boom that caused the recession ends, and entrepreneurs get to work reallocating factors of production. This often requires a period of high unemployment as people who are laid off from jobs in contracting sectors take time to find work in expanding ones. A recession turns into a depression when governments step in to fix the economy by spending money, fixing prices and wages, creating new taxes, subsidies, or regulations, nationalizing industries, and creating uncertainty for market participants. By trying to avoid the temporary pain of adjusting to the new economic reality, the government can make itself into the proverbial bull in a china shop, wreaking havoc with constant interventions. I would add the point of view of Marxist economists, for whom the recurrence of crises is the signature of the flaws of capitalism. There are several reasons to that, but I think the two most important ones are the downward pressure on aggregate demand and the tendency for the rate of profit to fall. Regarding the decrease of aggregate demand, because entrepreneurs always attempt to pay the workers less, to maximize their profit, the purchasing power of the population tends to decrease, and the aggregate demand with it. Regarding the tendency of the rate of profit to fall, there are several explanations, but according to Marx, this is because technological advances tend to increase productivity by replacing workers with capital automation. Since, according to Marxist economy, a profit can be made only by paying the workers less than the value that they produce, less workers means less profit.